You've probably done this without thinking twice. You're checking out online, and instead of paying the full amount, a little button offers you 4 easy payments instead. No interest, no fees if you pay on time. It feels less like debt and more like a convenience. Here's what that little button actually is: an estimated $156.7 billion of it sitting on American households right now. And by design in most cases, none of it shows up on your credit report. By the end of this video, you'll know why a debt this size is nearly invisible to lenders, to credit scores, and in some cases, to the people using it. You'll know about the rule that was supposed to bring it into the light, and why that rule quietly disappeared before it ever really started. And you'll meet someone whose story shows exactly how a convenient for-payment plan turns into something much harder to escape. But first, why do lenders let you take on debt they can't even see? Buy now, pay later, BNPL for short, split a purchase into installments, usually 4 payments over 6 weeks. Companies like Affirm, Afterpay, and Klarna built entire business models around this one idea: make borrowing feel like a feature, not a loan. It worked. Nearly 1 in 3 U.S. adults have used a BNPL loan at some point. And on paper, the pitch is genuinely reasonable. No interest, no fees, if you pay on time. For someone whose refrigerator just died, or whose car needs a new tire, that's a legitimately useful tool. Here's the part that made it grow so fast, though. Signing up takes seconds. There's no hard credit check the way there is for a credit card. You don't fill out an income verification form. You click a button at checkout, and the loan exists. Which means the same frictionless design that makes it convenient also makes it easy to stack. Multiple loans, multiple retailers, multiple 6-week payment cycles overlapping at once. And this is where the story stops being about convenience and starts being about something regulators have a very specific concern about. Nobody, not you, not your bank, not the next lender you apply to, can easily see how many of these you're actually carrying. You'd assume that's just an inconvenience, a minor gap in the paperwork. It's not. It's the entire problem. A Federal Reserve report published in June of this year put a number on this for the first time at real scale. Approximately $156.7 billion in BNPL credit was issued in the U.S. in 2025 alone. That's nearly 80% higher than the previous official measurement from the CFPB. Here's the sentence that should stop you. In most cases, none of these balances appear on a standard credit report. A lending industry analyst put it bluntly: a borrower with a 750 credit score could, in reality, be closer to a 620 once you account for BNPL obligations that simply aren't visible anywhere. Not to the mortgage lender approving their home loan, not to the car dealership approving their auto loan, not even, in some cases, to the borrower themselves once the payment plans start overlapping. This isn't an accident of bad record keeping either. In 2025, several major BNPL companies reportedly got cold feet about handing their loan data over to credit bureaus at all. Reporting this debt would mean it starts affecting people's credit scores, which sounds like exactly what should happen, but also risks the entire pitch that made BNPL popular in the first place, that it feels different from real debt. So you have a genuinely strange incentive sitting at the center of this entire industry. The companies benefit from this debt looking invisible. The convenience of the product depends on it not looking like a loan, and the people taking on the debt often have no idea how much of it is stacking up across different apps and different retailers because there's no single place that shows them the full picture. Total U.S. consumer debt, mortgages, credit cards, auto loans, student loans, and now this, hit $19 trillion in the first quarter of this year, according to the Federal Reserve. Credit card debt alone reached $1.25 trillion, up nearly 6% from a year earlier. BNPL sits on top of all of that, mostly uncounted. You'd think, given the scale of this, someone in Washington would have already stepped in to fix the visibility problem. Someone did, and then it stopped. In May of 2024, the Consumer Financial Protection Bureau issued what's called an interpretive rule, a formal clarification that BNPL pay in four products should be treated in key legal respects like credit cards. That meant BNPL lenders would have to follow rules under the Truth in Lending Act. Clearer dispute rights, standardized disclosures, protections that credit card users already take for granted. It wasn't a total fix for the invisibility problem, but it was a real, concrete step toward treating this like the consumer debt it actually is. 1 year later, in May of 2025, that rule was withdrawn. Notice the pattern here, because you've heard a version of this story before if you've watched this channel. A regulator identifies a real consumer risk, writes a rule to address it, and within about a year, the rule is gone. Not fixed, not improved, just removed from the books. This time it wasn't Congress using a fast-track legislative tool. It was the agency itself reversing its own prior interpretation. But the effect is the same. The protections that were supposed to start applying to 37% of BNPL loan volume, the fast-growing interest-bearing installment segment specifically, simply didn't materialize. And that interest-bearing share matters more than it sounds like it should. A nonprofit consumer advocacy group's 2026 report found late fees on some BNPL products running $7 to $8 per missed payment, with interest and financing fees that can reach up to 36%. And when those fees stack on top of each other across a missed payment cycle, the effective cost can work out to the equivalent of a 100% APR or higher. That's not a no interest if you pay on time product anymore. That's a product that behaves like the worst version of a payday loan, wearing the branding of a checkout convenience. So here's where this leaves things, right now, today. The debt is largely invisible to your credit report. The rule that would have added real protections around it was withdrawn before it took hold. And the segment of this market growing the fastest is exactly the interest-bearing part that looks the most like predatory lending once you miss a payment. Here's what this actually looks like for one real person, reported by CNBC this month. Ashley Reed had already maxed out her credit cards helping to pay for caregiving expenses after her mother suffered a ruptured brain aneurysm during a vacation together. With traditional credit exhausted, she turned to buy now, pay later. Not for a new phone or a vacation, but to keep up with the basic costs of caring for someone she loved. She became what the industry would call a frequent user. Multiple loans, ongoing payment cycles. Not because she was reckless with money, but because the emergency didn't stop needing to be paid for once her credit cards hit their limit. And BNPL was the next door that was still open. She's not an outlier. Industry data now shows more people using BNPL for groceries, for rent, for basic bills, not discretionary purchases. More than half of current BNPL users say they wouldn't be able to make ends meet without these loans at all. That's not a description of a convenient checkout feature anymore. That's a description of a financial safety net that 50% of its users say they now depend on just to get through the month. A safety net that, as you now know, barely shows up anywhere on paper. Here's a wrinkle that makes this even stranger. Even as the invisibility problem persists broadly, credit scoring companies have started, in a limited and inconsistent way, incorporating some BNPL data into certain credit models, meaning for some borrowers, in some cases, this debt is starting to show up after all. You'd think that's good news. Finally, some visibility. It's more complicated than that. Because the reporting is inconsistent across lenders, across BNPL companies, and across credit scoring models, what you get isn't a clear, reliable picture. You get a patchwork. Some of your BNPL debt might count against you when you apply for a mortgage. Some of it might not. And there's no straightforward way for you to know which is which until the application is already in front of an underwriter. In other words, the debt is moving from completely invisible to randomly, unpredictably visible, which is arguably a worse position to plan your finances around than either full transparency or full invisibility would be on their own. You don't have to wait for regulators to fix the visibility problem to protect yourself from it. If a lender can't see your debt, that doesn't mean it isn't there. It just means you're the only one keeping score. First, keep your own running total. If you're using more than one BNPL service at a time, write down every active payment plan in one place, because no single company or credit bureau is doing that for you right now. Second, treat a missed BNPL payment with the same seriousness as a missed credit card payment, not less. The late fees and effective interest rates, once they stack, can be worse than the credit card debt many people used BNPL specifically to avoid. Third, before you apply for a mortgage, auto loan, or any major credit product, assume your BNPL balances might factor in, even if they haven't historically. Pay down or close out active plans first if you can, rather than finding out mid application whether this particular lender counts them. A regulator saw this coming and wrote a rule for it. A year later, the rule was gone. The debt kept growing anyway. $156.7 billion of it, mostly invisible, increasingly essential to the people relying on it just to get through the month. This isn't the first time this channel has shown you a fix that disappeared before it finished doing its job. It probably won't be the last. The for payment button at checkout isn't going anywhere, but now you know what's actually sitting behind it. This has been Fox Method.